Well, hi everyone, Sean Humphreys here. Welcome to the All Things Retirement video series. Of course, we're talking about retirement. We've had several discussions on different aspects of retirement, and today we're going to talk about, do you know your number? You could even say, do you know your numbers? There are several critical numbers you need to be clear on when you're doing your retirement planning. And it's not just in the planning phase, you also have to update those numbers and review them on a regular basis. So in future videos, we'll talk about the various numbers, but today's particular video, we're going to talk about one particular number that's absolutely critical that you need to be clear on. And so as we get into this discussion, I think it's always important to focus in on our model for retirement income planning. Of course, for retirement, it's all encompassing as a transition. So, whether it's making sure that you're clear on purpose and vision for this retirement transition, cultivating purpose is always an important aspect around just life planning generally, and certainly as it relates to retirement income planning. We then have health. It'd be a shame that if you hit your retirement years but you didn't have the energy to really enjoy retirement. So the cultivation of health and best practices around that really critical. Of course, goal planning. Now, when it comes to retirement planning, there could be specific goals around after-tax income needs, inflation adjustments that you want to make sure you can deal with, and then also personal or aspirational goals. Being clear on your pension plan, how it works. Is there cost of living adjustments on it? Are the pensions integrated with government benefits? What will the benefit amount be? So being clear on that. Investment planning always critical because investments will have to supplement your pension incomes, and of course tax planning key because you don't want to pay more tax than is required, so you want to be smart in that area. And then for some of you, you might have redundant capital, and there's surplus capital to what you need to produce income over your life expectancy, and so you can engage in a very deliberate estate planning exercise. Okay, so that's our model, and today we'll talk more around the aspect of goal planning and knowing your number in that area. So why is this topic so important? Well, this particular topic around your number, we're going to talk about your return number. In other words, what kind of return do you need to aspire to achieve your retirement income goals? And that relates back to your portfolio. So your portfolio is going to drive a certain return, a certain growth pattern, and for many retirees, they're drawing on different parts of their portfolio to supplement other pension incomes on a consistent basis. And for others, it might be reaching into the portfolio to provide liquidity to supplement expenses that come up, whether it's for traveling or helping the grandchildren or improving property, that kind of thing. So there's lots of challenges around retirement, and I think that in today's discussion, we'll kind of link knowing your number, investment planning, with some of the challenges around the whole investment topic when we begin planning for retirement. So investing for retirement. The first piece of this discussion really ties to goals. Your goals will define what kind of return you need to reach your goal, your objectives from a retirement planning standpoint. Now, there's other factors that impact on this. Risk temperaments are really important ones. So everyone's going to be a little bit different on that continuum around their appetite or comfort level around investment risk. So your appetite around investment risk, your specific goals you want to achieve, really impacts your objectives around retirement and your investment portfolio specifically, and of course the return that you need to achieve. So you always run that through a filter or an analysis where you begin doing forecasting, and the forecasting exercise, which we'll talk about later on in this presentation, is a critical piece to get clarity on what that return number is. What is your number from a return standpoint you need to achieve? I think this schematic is very helpful in the sense that when it comes to investing, the only goal that matters is yours. There's just lots of chatter around investment planning. So whether I watch the news, read investment magazines, go to websites or blog posts on investment planning, I listen to the news and I hear about what the S&P 500 did, or the Canadian market did, or the EFA, or the international markets. And although that's interesting, you need to figure out, how do I link that back to my own personal planning? Or I go to a cocktail party and everyone brags about their latest and greatest investment and how they seem to consistently hit home runs. Of course, we never find out from them those experiences that didn't work out so well. So lots of chatter out there, lots of noise out there. And so what we want to do is cut through all that noise and go back to first principles, which will be, what are your goals Let's do a forecast to confirm the return you need to get your goals achieved. So that's this green asterisk or star. And then build a portfolio that for the highest probability and the lowest level of potential risk, your goals will be achieved. And at the end of the day, that's really the only number that matters. Now, I'm not saying that benchmarking your portfolio returns against GIC rates or savings accounts or the TSX or the S&P 500 or other investment vehicles is not appropriate. But at the end of the day, the only number that really matters, of course, is your number. Now, let me just give you a good example of that. So let's say we do a financial forecast for you for your retirement, but it could be other financial objectives as well, but we'll focus on retirement. And we conclude that we need to get, on average, a 4.5% net return to you consistently over time for you to fully fund your objectives over the long term. So as we begin implementing the retirement game plan, that's the number we're going to be benchmarking success. So as long as we're tracking that 4.5% number, then you should be satisfied and have peace of mind and confidence you're tracking in the right direction. Now, while that's happening, you're noticing that the U.S. stock market is doing a lot better than that. So you're getting 4.5% on average, but the U.S. stock market, let's say, has been averaging 7 or 8 or 9%. So increasingly, there might be some disconnect. You know, you want the U.S. market returns. You're dissatisfied with your performance, even though your performance is driving towards your goal. And what we did initially is we built a portfolio that for the highest probability, for the lowest level of risk, we've tried to hit the goal return without building an excessive risk. Now, if you want the U.S. market returns, then obviously we'd have to overweight geographically to the U.S., overweight stocks in the portfolio, and all of a sudden we're increasing the risk profile on the account, which should be fine as long as you as the client realize that's what you were doing. If we did that, then we'd have to sort of revisit the goals and revisit why we were driving to 4.5%. So if you want to try to get a better return, that's fine, but there's an implication around that. More risk potentially, more fluctuation in the portfolio, and yes, you might get more return, but there's not a given that that's going to happen for sure either. So it ends up being this ongoing dialogue between what you need and driving towards that goal for a risk level that you're comfortable with, and then of course making adjustments along the way. Now, this chart is a real practical example of why we should have these conversations. So when we work with clients, we assess their appetite for risk. We get clarity on the goals that they need to achieve, because we know that the reality for most investors is that they can very easily succumb to the cycle of investing. And really, when we say the cycle of investing, it's the emotional cycle of investing. So this chart kind of represents the typical market cycle, which is tied to the economy. So you see, coming out of the a recessionary cycle, you see this early bull cycle. So there's a little bit of excitement and people are a little more optimistic. We hit the euphoria state, which is the point of maximum financial risk, where people are, have emotionally really want to add to the market because they want to participate in some of the upward potential. We then see the early phases of a bear market. There could be some recessionary cycle that's hitting, and we see stock markets begin to decline. And all of a sudden, the emotional reaction is anxiety and fear and concern. And then if we go into negative territory, into a late bear cycle, you can see capitulation, despondency, depression. And this cycle is really indicative of what a lot of retail investors do. So they'll get optimistic when the markets are doing well, they'll get pessimistic when they're doing poorly, they'll tend to buy high and sell low. Obviously we know that, at least intellectually, we should be trying to sell high and buy low, take advantage of opportunities. But that doesn't happen statistically. If you look at the cash flows going in and out of investments through market cycles, typically retail investors do the opposite. So by going back to the previous discussion where we're focusing on your return and trying to moderate risk as much as possible, we reduce the risk that a client will succumb to this emotional roller coaster. Because ultimately, when you look back historically at people's experiences, it's the emotion that drives behavior sometimes, and that behavior can sabotage your success as an investor. We're really big believers in coaching. We think the coaching model is a very powerful one as it relates to the whole area of finance. And so let me just walk you through, what a coach does. They really get to know you, your dreams, your goals, your aspirations for the future. They assess your current situation, and when they assess the current situation, what they're trying to do is they're trying to look for opportunities, gaps, things that we can exploit to help you move in the direction of your goals and your dreams. Once that's accomplished, then we want to make sure we develop an action plan. And not only the action plan, but to help our clients move through the implementation process so that that action plan is being acted on. As that's happening, there's ongoing accountability and encouragement. That's what a coach does, because again, all of us get busy. We get, succumb to the emotion of the moment. We have transitions and changes in our life that can potentially derail our planning unless we have, sober second thought, someone giving us perspective, accountability, and encouragement. I think that's a really big, important role that a wealth planner or retirement coach does. And then over time, reviewing, and fine-tuning and adjusting, because there's changes to tax law, economic cycles, personal circumstances that will impact on that plan. So we believe in the coaching model. We think it's a huge, huge value add for those clients that embrace it. When we get involved in coaching clients, I talked about the assessment and the gaps that are identified. We have what's called a gap analysis, and this is a visual representation of the gap analysis. Here you've got clients, this green line that cuts across this chart was what they wanted to be able to spend. When we did the initial analysis, the green is their portfolio value that was supplementing pensions, and then in their late 70s there were gaps that began to emerge. That is a great starting point then to look back at the client's current situation and identify strategies that they could employ to make sure that that gap is dealt with. So in your own circumstances, ask yourself the question, do I have clarity on my numbers? Do I know what return I need to get to achieve my goals? Do I know what level of after-tax income is sustainable? Do I know what rate of inflation I can cope with over time? If you don't have clarity about your retirement, don't have complete peace of mind, then what I'd encourage you to do is to reach out to us. Of course, shumphreys@asante.com is the email. Contact information by phone, 204-977-8049. Of course, you can visit our website, seanhumphreys.com. And in the notes for this video, you'll see a link to our website that will take you directly to a page that explores our retirement coaching program in more detail. And there's some free resources there that you can grab hold of. We're not asking for email information, that kind of thing. You just grab it. We've got a sample financial forecast there. We've got a tips sheet for retirement. And we have a bit of an audit list, things that you should be thinking about as you're beginning to prepare for retirement. So that's it in terms of the knowing your number discussion. I hope you found it helpful. And obviously we wish you all the best as you plan for your future retirement or continue to monitor and do the best you can financially.